Hello, fellow Rebel Capitals. Hope you're well. So, unfortunately, the derivatives market, the probably $2 quadrillion derivative market, is starting to show some cracks. So, this is something we've got to be aware of. What I'm referring to specifically are negative interest rate swap spreads, or when interest rate swap spreads, go negative. Maybe that's a better way of saying it. So let's go into what's happening here. The BIS is starting to talk about this. Snyder's been talking about this for a long time. But the BIS just came out with a report, and we're going to look at what they're saying, and I'm going to show you why it's completely bogus. And then I'm going to connect the dots for you and tell you why this is actually a really big problem that we need to be aware of. So you guys know the systemic risk with derivatives. I don't need to explain that one to you. So let's start by going over to, let's go over to my Twitter feed. And this is the actual tweet from the BIS yesterday. And they say negative swap spreads may signal high premium for holding government debt. Okay, that's their first fail right there. Because what they're not doing is using common sense. And you've just got to say, look, it's a spread, right? What do they? Well, I won't get too frustrated now because I don't want to go down that rabbit hole or go off on that tangent. We'll come back to that in a moment. But you just have to realize that they don't care about, how much issuance is going to happen in the future. That's not that's not why a dealer would get involved with an interest rate swap spread. They're just looking for an arbitrage opportunity. Now, you could argue that, okay, maybe it costs them a few extra basis points now because they're using the treasuries that are on their balance sheet, or they're maybe buying more treasuries, adding that to the balance sheet, increasing that balance sheet size, and therefore they have to pay a price for that due to regulations and yada, yada, yada. And therefore, they don't want to get involved with these spreads. But when the spreads go further and further and further and further and further negative, something's up. It's not just the fact that these dealers are constrained as far as their balance sheet capacity. Now, let me be clear. They're not constrained, or they might be constrained, but only because they want to be constrained. It's not because regulations are the only thing that is constraining them and making the cost of getting involved and taking advantage of that free arbitrage increasing to the point where they don't want to get involved with the trade at all. So, like I always say about selling treasuries, or there's a big difference between, or creating liquidity in the global monetary system. There's a big difference between the ability to create liquidity and the willingness to create liquidity. So here, there's a big difference between the ability to expand their balance sheet and the willingness to expand their balance sheet. The starting point for the BIS is that they don't have the ability to expand their balance sheet anymore because of regulations. And even if they do, from a financial standpoint, it doesn't make sense. Now, right off the bat, let's just assume that the cost to them for adding these treasuries to their balance sheet to do the swap spread to begin with, or to take advantage of that arbitrage, let's just say that costs them, 15 basis points. Okay, fine. But let's go back to their own charts right here. And the red line is a 10-year treasury. And this goes back to 2018, 2020. And then you can see where we really start to go negative here into 2024, and where we are today, which is, it's a USD. Oh, the floating rates there. Okay, so we're at negative on the 10-year. We're negative, call it 30 basis points. So my point is, if I'm reading this chart correct, so my point is, why all of a sudden is there a higher cost, let's say now, than there was in 2022? or even in 2023, because that's when they argue that all this issuance came out. Okay, so why weren't the swap spreads negative 30 back then? If it's all about just the additional cost of expanding the balance sheet and holding these treasuries due to SLR requirements or GSIB requirements. So that now, if you said, okay, when they came out with these regulations, which was GFC, if they immediately went to negative 30, and that's what we have seen since then, okay, then they might have an argument. You could say, okay, there's definitely a causal component there, or there's likely a causal component there. But if we're positive all the way to, let's just say 2016, and the regulations changed during the GFC, and then we just go steeply negative, then pop back up, and then go negative again, just coincidentally during the cerveza sickness, and then we go back up, and now we're negative to the point where I think is unprecedented, looking at this chart. Just the simple fact of the regulation change and adding a cost for holding treasury to the balance sheet, that doesn't make sense. There's got to be something else to it. That's really my point. So you can go ahead and just eliminate, cross this one off the list, is this high premium for holding government debt. No, because if there's a high premium today, there was a high premium back in 2012 when they weren't even negative, let alone negative 30 basis points. Now, their rebuttal is going to be, well, yeah, but there wasn't as much issuance back then. And because there's so much issuance now, and by the way, it's interesting because they always say that the Treasury, the lack of issuance is why we have an inverted curve. It has nothing to do with a recession. But here what they're saying is because of the issuance, specifically in the 10-year Treasury, that now all of a sudden these dealers don't have any balance sheet capacity because the cost is just way too high. I mean, again, they're just contradicting themselves and none of it makes sense. So if none of it makes sense, you've got to say, okay, well, maybe their explanation is inaccurate. But instead of them just having the awareness, the self-awareness, and maybe the humility to say, you know what, maybe our model is incorrect, just based on pure common sense in these charts that we're actually showing in our example. So instead of having the humility to say, hey, maybe we should take a look at these models here. Maybe we're missing something. Nope, they just double and triple down. And this is why I give them, one of the reasons why I give them such a hard time. Because it's like, come on, man. I mean, I'm some schmuck on YouTube. I almost flunked out of high school. I've never taken a finance class. I've never taken an econ class. I've never even taken an accounting class. And yet I can I can call BS, right? If I can call BS on you, you know you need to go back to the drawing board. I mean, come on. Now let's keep going here. And what I want to do next is go over their explanation based on a video that they attached to this from the BIS or the BS. And then I'm going to go over my view as to why this is happening from a standpoint, not of Austrian economics, not of Keynesian economics, not of economic or econometric models, but just common sense. Maybe it's not so common, right? Like that saying. So let's go over here and switch up the screen share so you guys can see this wildly entertaining video from the BIS. And if any of you out there are aspiring content creators and you're thinking about potentially doing video, this is a perfect example of what not to do. Perfect example of what not to do. Oh, shoot. I did the wrong screen share, Josh. Dang it. There we go. That's it right there. Okay. Josh, can you see this?
Yes.
And how's the audio? You got it?
Yep.
Okay, great. Here we go.
Normally, government bonds tend to yield less than private borrowing rates.
as government bonds are safest. But recently, the difference between the fixed rate of an interest...
Number one mistake for all you aspiring content creators. If you're the expert on the subject matter, you shouldn't be having to read it from a script. Look at this guy's eyes. They're sitting there going like this. It's blatantly obvious that he is reading from a script. And not only that, could you be more robotic, for heaven's sakes? And Josh, I know that you're on Tinder all the time, trying to get dates. So you want to hop on here? Let me give you a quick tip for your Tinder profile. Josh, you going to hop on here for the quick tip or what? MIA. There he is. Okay, so you see our buddy Mateo here? Josh, you see this?
Yeah.
You see his collar right here? This is horrific male hygiene. This is totally unacceptable. So what he's doing here is he has a collar stay in this collar, but he has no collar stay in this collar. So it curves around like this. And it looks like he is a 12-year-old that borrowed this shirt from his father and didn't know how to put it on. The worst. So for you guys out there, like Josh, you young guys, when you're setting up your Tinder profile or taking your pictures, when you're wearing a collared shirt, make sure you have collar stays on or in each collar, and preferably the nice high quality metal ones or the plastic ones that come with a magnet that you can clip it there so they stay perfectly in place. This is totally unacceptable. This is completely unacceptable. All right, getting back to it. All right, give us some energy here, Mateo. I want to feel your passion, buddy. I'm not seeing it right now.
interest rate swap and the yield on a government bond, which is called the swap spread, has been pushed into negative territory.
And here, by the way, based on this, maybe I'm reading that other chart. Oh, okay, got it. So I was going to say maybe I'm reading incorrectly, but the pink line here, they're just referencing the floating rate on the interest rate swap as opposed to the fixed rate side of it, which would be represented by the red line. So we want to focus on the fixed rate. And they're saying this is IBOR floating rate. Well, what on earth are they? We're going to get back to what they're referring to specifically. When you're looking at negative or any swap spread, what you're doing is you're looking at the 10-year, let's say, and then you're looking at the same maturity swap spread, but you're looking at the fixed rate. You're not looking at a floating rate. So I don't know why they're showing us floating rates, but bottom line here is that the concept is still the same. Whether the 10-year swap spreads are negative 25, 30, 50, whatever they are, I know they're getting a hell of a lot worse. And that's all that matters. Okay, let's get back to it.
In many jurisdictions. This is unusual. Some factors are purely technical, notably the shift in reference rates in swaps, away from LIBOR to so-called risk-free rates.
There are other drivers, though, that suggest an increasing difficulty.
So now Andreas steps in with an even more magnetic personality. You can feel the charisma just oozing from Andreas. And Andreas and Mateo, I'm sorry to give you a hard time, but just don't read the teleprompter, buddy. You're the expert. Just right off the cuff. Tell us what you think. Explain it. Don't read it to us in a way that's so unauthentic. You look like a robot from George Jetson, for heaven's sakes.
Of markets and intermediaries to absorb large supply of government debt. This has also shown in relative...
Look at his eye. He's not even looking at the camera. His eyes are like over here. like this while he's reading the script. This is what not to do when you're creating YouTube content. You got to be authentic, guys. It's better just to roll with it, make mistakes like I do all the time, throw in the uhs and the ums and the maybes and all these things. People want to see the authentic version of you. They don't want to see the robotic version of you.
Relatively weak demand at treasury auctions, pushing up bond yields.
Okay, so now he's talking about pushing up bond yields because of weak demand. And keep in mind, this is like 4 months ago. So if we look at and of course, it's a perfect contrarian indicator when the central planners talk about bond yield blowing out. So because once they start talking about it, it's time to take the other side of the trade. So if we look at the 10-year going back 4 months, my guess is that's right around when it was probably 480 or so at its highs. So we'll go back 6 months. And yeah, of course. Of course. So this is when they're trying to explain the negative swap spreads, including their analysis of why yields are blowing out. And like, the dealers don't have any balance sheet capacity. Therefore, they don't want to buy these terrible treasuries because of all this issuance that's going to come out. Forget the fact that they're going to pocket a free 30 basis point spread and they can lever up to a trillion to one. Just let's sweep that one under the rug. That uses too much common sense. We just have to understand that yields are blowing out, and that has to be somehow related to dealers not wanting to participate in this negative swaps or this arbitrage opportunity. And it has everything to do with their inability to buy more treasuries and lack of demand. And then as soon as they come out with that, of course, what does the interest rate do? Goes straight from 4.8 down to 3.9, 100 basis points, call it, straight down. Now, of course, it has really jumped recently, as you guys know from watching my videos, up to 4.5, but now back down to 4.3. Okay, let's get, shoot. And I just remembered that you guys could not see that chart because we're back here on Mr. Magnetic Personality himself. Okay, sorry about that, guys. Well, hopefully you followed along with what I was saying about the chart that I thought you could see, which you actually couldn't.
Dealers have already taken a lot of government bonds on their balance sheets. They require a higher bond yield and hence a lower swap spread to recoup their intermediation costs and to be willing to absorb additional supply.
So they're intermediate. Okay, so again, these costs, how have they changed since the GFC? It's not like we just have these regulations where they had to incur the cost. So that's a constant. And they're making it sound like it's just something that, where did that come from? It all just hit us out of nowhere here. And then they're talking about how these dealers have been forced to take all of this issuance onto their balance sheet. I don't know. How do you know, Matteo or Andres, or how do you know that? Have you talked to them? How do you know they're not choosing to take more treasuries onto their balance sheet? Because they're the safest and most liquid asset. You see, you assume they're being forced, but how do we know they're not doing it intentionally? And by the way, why would they not do it intentionally when they can pocket this free 30, 40, 50 basis points? And I'll give you my explanation as to why, using the school of common sense economics here in a moment.
Negative swap spreads could be a signal that investors are demanding higher government bond yields in the face of large supply. This matters for several reasons. In coming years, governments plan to issue a large amount of debt they need investors to buy, and sovereigns may no longer enjoy the cheap funding costs as they did for a long time in the past.
Okay, so what he's implying there is these dealers, oh my gosh, we don't want to take these treasuries on our balance sheet because they're going to issue so much in the future that's going to drive up interest rates, and then that's going to drive down the prices of the treasuries that we own. Nonsense. Again, you have to remember that they're matching up maturities. They're going into a 10-year interest rate swap, and they've got a 10-year treasury. They don't care about issuance. It's absolutely irrelevant to them. Why? Because they're just pocketing a spread. So they don't care what happens to the price of the underlying asset. It's just like if I told you, if you could use other people's money and buy $1 billion worth of 10-year treasuries at 1% and then pay 0.5% to the other people and just pocket a 50 basis or half a percentage point on $1 billion, would you do it? You'd say, of course I would. This is a no-brainer. In fact, give me 2 billion, give me 3 billion, give me 10 billion. Now, would you say, oh, well, oh my gosh, I don't know about that, because the value of these treasuries that I'm buying with other people's money, they could go down in value. You don't care. You don't care, because you're going to get the principal back at the end of the 10 years, regardless of what the price does in the interim. So that in and of itself is a total non-starter. If you're not using econometric models, and if you're using, or you're coming from the economic school of common sense. And if, this is another, probably the most important thing, is you've got to have on collar stays. Guys, come on. The ladies out there, there's a lot of competition. And trust me, if a gal sees this, if I was a gal, I would just completely blow you off. I would immediately ghost you on Tinder if I saw something that was that much of a fashion faux pas.
There are also consequences related to market functioning. Government bonds set a benchmark for pricing other assets, and they also represent a safe haven in turbulent times, and are a crucial collateral assets for many financial institutions. Any upset in these markets can have substantial effects on the real economy.
Okay, you see what he said there? And they're very important collateral for financial institutions. Let's rewind.
Can have substantial effects on the real economy. It is therefore crucial collateral assets for many financial institutions.
They are crucial collateral assets for many financial institutions. All right. So what do the dealers do with those treasuries that, according to the BIS, they're just forced to take? And they're like, no more treasuries. No, get it away. We're sick and tired of making all these billions of dollars risk-free. We don't want these things anymore. According to them, that's what they're doing. But what are the dealers doing in addition to this arbitrage play? They're taking and they're lending those treasuries out to the financial institutions and the monetary system that need them, because they are a crucial collateral asset. And let's add a little bit more to the mix here. When risk goes up in the global monetary system, the demand for collateral, as you can imagine, would also go up. But there's a problem. You see, we have a collateral multiplier. So one treasury can live on, let's say, 10 balance sheets. All right, but that's when risk is low. Because if risk is low, then these dealers and these counterparties are willing to accept and deal with all these rehypothecated treasuries. But if risk goes up, then the collateral multiplier goes down. And instead of that one treasury being able to live on 10 balance sheets, now it can only live on 2 balance sheets. So effectively, the amount of collateral in the system is shrinking regardless of what is happening with Scott Bessent, the U.S. deficit, and issuance. See? So if all these dealers are seeing economic storm clouds, are seeing risk increase, like, we know that in some time in the very near future, there is going to be a scramble for collateral from all of these counterparties or these financial institutions that Mr. No Collar Stay is talking about. And we know that when that collateral multiplier goes down, we're going to be holding all the cards because we have the collateral. And therefore, we can lend that collateral out and we can charge a massive spread. And we can make billions on top of the billions that we're making by using these treasuries in the swap spreads or the interest rate swaps to begin with. So I think, and I want to try to give them the benefit of the doubt. I think one of the big problems here is these accountant types that have never really had a business or never really had a real job, these academics. I think they look at everything through the lens of, well, what is the regulation? Like what does the central planner want me to do? And whatever the central planner wants me to do, then that is what I'm going to do. As opposed to looking at it through the lens of an entrepreneur and saying, how can I make the most money possible? How can I maximize my profit? And then if you're looking at it through the lens of an entrepreneur and they say, oh, well, obviously you're forced to take these things, that's looking at it through the lens of a central planner and just some person that just takes all these rules as if you have to follow them, and you even have to follow the intent of the rule if that's what comes down from the tablets on Mount Sinai, i.e. the Fed. Where the entrepreneur is like, yeah, that GSIB thing, whatever. If I'm taking all these treasuries, hey, it's going to be because I'm making more money and the risk makes sense. So if I'm taking these treasuries, it's because I want to and because there's a profit opportunity, not necessarily because I'm forced to. You see, I think that, so for me as an entrepreneur and someone that actually lives in the real world, I'm always looking at it through that lens. Like, no, this is about making profit. This is about incentives that are outside. This is about risk reward incentives that are outside the realm of what the central planners want you to do. And if you need any proof, I would give you reserve requirements. Whenever I talk about liquidity or the fact that the Fed's balance sheet really doesn't matter that much, I always get people saying, oh, well, okay, sure, their balance sheet didn't go up from 1980 to 2007, but what about reserve requirements? Obviously, the Fed had a 10% reserve requirement, and that controls the amount of money that these banks are able to create in the lending process. This is someone that obviously has never done 1 minute of homework, because you look at the 10% reserve requirements that we had. Okay, fine. In 2007, we had $40 billion with the B reserve requirements. How much did we have in M2 just in the United States? That would be 7.5 trillion. Do the math. There ain't no 10% reserve requirement there. Or there might have been, but the banks were just giving them the finger. They're like, yeah, reserve requirements. Good one. Yeah. All right, Jerome. We'll see you at dinner tonight. Steaks are on us. But bring more of those jokes like the reserve requirements. That's great. That's a knee slapper, my friend. That's a knee slapper. What do the banks do? They just set up sweep accounts. And they basically just took their deposit liabilities and just transferred them over to a money market fund. And then that money market fund just gave them a loan. And it's basically a liability swap that got them around these reserve requirements. So you get my point. It's like, I don't care what type of GSIB or SLR or Basel III or anything like that. I think you're just completely naive to think that these, and let's remember that the banksters are the most greedy. And I think they always have been. I don't think the greed has gone up exponentially. I think there's just as much greed today as there was 50, 100 years ago. It's just human nature. So to think that on one hand, these banksters are just ravenously greedy, but yet at the same time, well, they are, but if there's a rule, they're going to follow the rule. I mean, it's childish. It's childish. But I think it makes sense coming from these guys, because these guys are the people who set the rules. So they want to make it seem like they have all this power. And if they set a rule, then those banks are going to abide by it. So they have to look at everything through that framework. And that's probably where they have to literally, if they have a thought of common sense, they have to extract it from their mind immediately. Like they're one of those monkeys, you know, like this and this and this, like, common sense, get it away, get it away. It's like Dracula in sunlight in the morning or something like that. Because that common sense defeats all of their arguments. And then if it defeats all of their arguments, then they have to look themselves in the mirror and realize that they don't have any power. And that stupid PhD they have is useless. And this status that they have is a joke. It's all an illusion. And the status that's in your mind is something that other people, the banksters themselves, are just looking at you and laughing because you think you're something that you're not. Let's get back to the interest rate swap spreads here. So what is going on in my view? Because what we have to understand here, and I'll get a fresh piece of paper, and I'll probably do a whiteboard on this next week. A lot of people were requesting that. So let's just say, we're going to make the math super easy here. So 10%. So here's the dealer. And let's say they're going into an interest rate swap where they have to pay 10%. Okay? But then they're getting, and that's the fixed leg. But then they're receiving the floating. And let's say they're receiving, 8%. Okay. So then what they do is they go out to the repo market and they borrow $1 billion. And they buy $1 billion worth of treasuries that are yielding, let's say, 11%. And that delta between the 11% and the 10%, that's your negative interest rate swap spread. So they're pocketing 1%. Now they have no money out of pocket, none, because they're borrowing all the money for the treasury to begin with in repo. And you say, well, George, aren't they exposed? Because that repo rate is overnight. So if the rates do go up, let's say from 8% to 11%, well, now that takes away all of the spread that they're making. That's not true. Because if both the repo rate and the floating rate are based on SOFR. So if SOFR at 8% initially, if that goes up, then the floating rate that they're receiving from the counterparty is going to go up the exact same amount. So even if their funding costs go up because they have to roll it every single night, it doesn't matter because it's all based on SOFR. So they have absolutely no risk as far as borrowing the money to buy the treasury to begin with. And then they're sitting there pocketing the 11% from that treasury for 10 years, and they're paying 10% for 10 years. You see why this is just a complete and total no-brainer. No-brainer for the dealers. So then you'd have to ask the question, using common sense, why? Why if it's not regulation? Because they look out there and they see the storm clouds. And they're like, we have the ability to expand our balance sheet, regardless of these stupid GSIBs and SLRs and regulation. We have the ability to expand, but we're not gonna. We're gonna choose not to expand our balance sheet because even at this 1% spread, there's so much risk in the global economy that we don't even want to deal with it. We don't even want to deal with it. There's that, and let's keep in mind, guys, I forgot to, right here, we got a counterparty, right? So what if that counterparty blows up and doesn't pay the dealer? So you have to factor in that risk. So it isn't necessarily that these swap spreads are going even further negative because, oh, we just don't want these treasuries. Yuck, get them away. It's most likely because the amount of risk is going up in the system, including the counterparty risk that dealer might not get paid from that guy that is supposed to give them that floating rate. And then you say, well, why would the counterparty want to take the floating rate, right? Or why would they want to pay the floating rate? Well, because in their view, interest rates are going down. I'm not saying they're correct, but that is what would motivate them. They want the adjustable rate. They want to pay they want to pay the adjustable rate, and they want the fixed. Because let's say they're receiving the fixed at 10%, and they're correct that growth and inflation expectations looking out over the next 10 years are going to go down, and then that floating rate goes from 8% to 5%, then guess who wins? That would be the counterparty, because they're getting the delta. You see, they're getting the delta now. Initially, they're receiving the 2%, but now they're receiving an additional 3% because rates have gone down, right? The SOFR rate, let's say Fed funds. So that's why they want to take that bet that rates are going to go down, and they want to receive the fixed and pay the floating. And that's what creates that opportunity, or one of the things that creates the opportunity for the dealer. So the long story short here is make sure you're wearing collar stays. That is number one. But secondly, when you look at this stuff, use common sense, for heaven's sakes. And don't ever get stuck in this position where you think that the banksters, the greediest people on the planet Earth, are somehow not going to find a way, or at least try to find a way, around these regulations. And in using that common sense, just ask yourself, why are they not wanting to take advantage of that profit opportunity if they can? And you come to your own conclusion, but my conclusion is that the counterparty risk within the global monetary system itself is increasing substantially. And you see that not only with the dealer actions, but also the counterparty actions, because they're seeing risk increasing, meaning growth inflation expectations going down, meaning higher probability that the Fed drops rates, and that SOFR rate they have to pay is going to go down, and they're going to pocket a bigger spread. So getting back to the derivatives market, guys. Oh, shoot. And I didn't have those charts up. Doggone it. That whole time that I was just sitting there talking to you guys, I was going over the charts. And I forgot that I had the screen share pulled up to where you guys were just staring at our boy Mateo here in his jacked up collar. All right. Well, jeez. You're just going to have to listen to the video again and pull up the original charts that you can find on my Twitter feed. And that will make things all work out in the end. So main takeaway there, guys, is in my view, this isn't about them having to or not having the ability to take on the treasuries. It's about the willingness of them expanding the balance sheet isn't there, because risk is going up. And if risk is going up in the, call it 1-2 quadrillion derivatives market, that is something that is obviously systemic that we need to pay close attention to. All right, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market, capitalism. See you in the next video.